Good evening, everyone. I am Doug Gerlach from Better Investing, and we're going to talk about our approach to dividend investing, particularly as it relates to stocks, which is our bread and butter at Better Investing. Better Investing is a nonprofit investor education organization. You may know us as supporters of investment clubs, but we also provide tools for individual investors and a stock analysis methodology called the Stock Selection Guide. This is, of course, our disclaimer. This is an educational presentation, and we always advise you to do your own research before you make any investing decision. I'm going to pick up where Charles left off and talk a little bit more about the history of yields as they relate to stocks in the market and why chasing yields may not be the most productive strategy for most investors. A little bit of background, our subsidiary Equity Research Service, part of our iClub Central for-profit subsidiary, publishes 3 investing newsletters. I'm the editor-in-chief of all 3 of these. The Investor Advisory Service is our flagship stock newsletter. It was established in 1973, so it has a very robust track record of outperforming the market during bull and bear cycles. It's been named to the Holbert Investment Newsletter Honor Roll for 15 consecutive years, more than any other newsletter in the US for its consistent long-term performance. The second newsletter we publish is the Small Cap Informer that was founded in 2013. So we have more than a dozen years of track record for that publication, outperforming the S&P Small Cap 600 index. And then in 2023, we launched the Dividend Informer, using a new approach to long-term investing, using quality and dividend growth metrics to reduce volatility and still deliver a performance that's acceptable for individual investors. And as part of that, we spun off some of the stocks we had been tracking in the Investor Advisory Service over to the Dividend Informer. Now we track about 50 different companies in the Dividend Informer. We do not offer a model portfolio, but serve more as a research service for self-directed individual investors. We track around 70 or 80 stocks in the Investor Advisory Service, small, mid, and large cap, and focus primarily on around 40 smaller companies in the Small Cap Informer. So this gives us a little bit of a sense of what we're all about and how we came to our dividend newsletter strategy. Trying to answer that question: does dividend investing, as it is traditionally known, still valid here in 2025? Traditionally, dividends have been part of a lot of different investing strategies. Charles outlined a couple of those, but a lot of the thinking, the conventional wisdom that governs dividend investing may be slightly outmoded due to shifts in the markets and business practices over time. And so we really have come to believe that if you want to invest for dividends, you should ensure that the companies that you're investing in have a sturdy growth component. That is, the capital appreciation needs to be part of the formula in order to deliver the returns that you're probably seeking. If we look at this graph of the yield of the S&P 500 going back to 1870, we'll talk a little bit about the history, because I think it's really emblematic of shifts in thinking and shifts of analytical approaches to dividends. The classic dividend approach, a value-oriented approach to individual stocks, really originated after the 1929 crash, when some of the brightest academic minds said, well, we got to figure this out, because things were pretty crazy when the market crashed. In the aftermath, isn't there a way that we can identify which stocks are going to perform better? And so, Graham and Dodd and Fisher and a lot of other academicians and financiers went to work and came up with some of the rules that have drifted through the decades and informed a lot of individual investors' approaches today. In the late 30s, 40s, and into the 50s, as you see illustrated on the graph here, yields were 4 to 8%, and dividends were a major part of the total return of most investors' portfolios. You could really invest in dividend-paying stocks and earn a return that would outpace inflation, that would outpace the GDP growth, that would perhaps deliver a little extra return in capital appreciation and satisfy the needs of many investors. In the 1960s, the so-called go-go years, when technology and innovation really started to be embraced by American businesses. We had all sorts of technological innovations like the Polaroid camera or the Xerox machine, and we sent a man to the moon, and there wasn't anything that Americans couldn't do. And these new innovations required a lot of capital, and so yields, as you see on the graph here, fell to as low as 3%. So in many cases, much lower than the 2 decades prior. As we went into the 1990s, we had another period of economic expansion, coupled with rising appreciation of stocks and tech stocks in particular. This whole new dot-com era had arrived, and these new companies were very popular, and they weren't paying dividends. They needed their capital to grow their businesses. And so, as you can see here, yields continued to fall as a function of the appreciation of share prices, as well as company policies regarding dividends. And then as we arrive into the last 2 decades, certainly lower interest rates and shifts in federal policy really helped boost stock prices faster than the growth of dividend and reducing that equity risk premium. Yields in this period of last 20 years have rarely exceeded 2% and have in fact fallen this year to what is pretty much an all-time low yield for the broad market of around 1.2%. And so this is certainly giving a lot of traditional dividend investors pause, trying to navigate what is going on with yields and dividends right now. Certainly, we are in an era where boards of directors and company managers are embracing what you might call more conservative dividend policies, but really it's a preference for how they're using their capital. Companies would rather now use their cash in ways that are easier to halt or increase than paying dividends. Because of course, a company that cuts its dividends is often viewed pretty negatively. And so instead of initiating that dividend or perhaps raising the dividend by a significant amount, they will push through marginal increases in dividends and use capital instead to buy back shares, which has the function of increasing earnings per share. And you'll see this quite frequently with board authorizations being announced in company earnings releases as the boards contribute more capital towards repurchasing shares, both as a signal to other investors that they believe their share price is undervalued, but also as a use of capital that if they authorize and they don't carry through with all those purchases, nobody seems to pay any mind to that. And alternatively, if they were to increase the dividend, then they would be beholden at that new rate, and that would reduce their options for using cash in the future. Certainly, debt repayment is also part of that. Again, something we hadn't seen in a good chunk of the last 2 decades with rates being so low, but companies now, as their interest rates have climbed back up again, looking to reduce their cost of capital, reduce the interest expenses, and so might be using their excess cash to repay debt. And we view that as a positive. That's a good move. It's very shareholder friendly to reduce your borrowings and reduce your interest expenses over time. All this together combined has contributed to payout rates declining significantly. The payout rate, of course, is the percentage of companies' earnings that's paid out as a dividend. The average payout ratio of the S&P 500 has dropped from around 56% over the last 100 or so years down to 36% today. So that's a pretty significant drop, and I think that's a good harbinger of where yields and dividends are headed in the current corporate era. So this new approach to dividend investing that we've embraced in our Dividend Informer newsletter focuses on total return, not just yield, but in dividends plus capital appreciation. And we believe that this, using a sounder strategy to dive beyond the yields into company fundamentals and capital usage is really key to a strategy that looks to benefit from corporate dividends. You can't simply go out now and just buy any old high yielding stock. As Charles pointed out, often those highest yielding equities are the ones that have the most risk embedded in them. There's something flawed with the company, so they have a reduced potential to grow their dividends perhaps, and dividend cuts may be on the horizon. So we have criteria that we've established and that we utilize in our newsletter for criteria. I'm going to talk about these, and we'll give you some example companies that fit the bill using the scoring system that we utilize in the newsletter. We look at 4 key categories for companies that are considered to be covered in the newsletter. These are capital return, growth, stability, and governance. And we score them all on an A, B, C, or D scale. Very rarely will a company that scores D in any of these categories be included. And needless to say, if they fail completely, they're not in the running whatsoever. So here are some example companies. I'll show you some fundamental graphs that come from our Better Investing SSG Plus, Stock Selection Guide Plus application. But these are, it's interesting, as Charles mentioned, that you rarely find a perfect company that scores across the board at the top level in all of the categories, and we've definitely found that to be the case as well. So we never see, have yet to find a perfect straight A company in our coverage. So a mixture of A's, B's, and C's can often be a recipe for finding opportunities and good values in these types of companies. So the first category is capital return. It's really assessing the company's shareholder friendliness through their use of dividends, share buybacks, and share offerings. Because after all, if a company is issuing more shares, if they're capital intensive and they're issuing more shares and generating dilution of their earnings, that's not always in the best interest of shareholders. But certainly, how is the company, what are their policies regarding the payment of dividends, regarding the growth of the dividend, and are they increasing it regularly over time? Are they buying back shares? Are the number of shares outstanding declining over time? Or they, and often it's the case that companies will be buying back shares, but the result is a net zero change in the number of shares because they're issuing options on the other hand. So they're merely buying back shares to cover those employee options, for instance. So you need to really understand, and this is how our long-term graphs often come into play. So 2 of the stocks that score highest in this area are AbbVie, the medical supplier, and you can see the graph here of shares outstanding and the dividends per share. So obviously we're seeing dividend growth. That's what we look to see. And we're seeing some general downtrends in shares outstanding. Of course, when you look at a 10-year history like this, there will always be cases, as with AbbVie, where more shares were issued for particular purchases, for acquisitions or other purposes. And so you will see that that does not disqualify the company as long as we understand it and we see a stable number of shares outstanding for the last 4 or 5 years, and so that to us equates, doesn't shift our opinion in this area for that company. And then the Hershey Corporation, also you can see a distinct downtrend in shares outstanding while dividends are increasing. That to us says this is a company that is focused on shareholder friendly practices when it comes to capital return. The second category is growth. Our primary stock selection guide methodology that we use in Better Investing is primarily growth focused, but we also believe that growth of sales and earnings is required in a dividend strategy. Because without that growth of sales and earnings, companies are not likely going to be able to increase their dividends. And we think that dividends should be growing as a way to reward investors over time. So primarily we'll look at sales, pre-tax profit, and earnings per share. We'll also focus on cash flow. We'll talk about that a little bit later. So we like it when companies are growing. They're growing. Consistency is valued, it's not required. In this case, we see Abbott Labs on the left, revenues, pre-tax profits, and earnings per share trending upward over the last decade. On the right is a smaller company, so they're not all large cap blue chips. This is Carrot Packaging, and again, you see the revenues increasing, you see the pre-tax profits increasing, you see the earnings per share. Increasing down below. Occasionally you'll see some dips, but over the longer term, you will definitely see that. We will not see, we're not going to see companies growing or seeing their growth stalled. They're not going to be growing at the same rate that you might require or demand for a pure growth investing strategy. But we do like to see, a particular level of growth, typically not much below 7 or 8% on an annualized basis. Our third category is stability. One of the objectives of our dividend investing strategy is to reduce portfolio volatility. And we do that by seeking out companies with consistent growth of sales and earnings per share, or in the case of real estate investment trust, funds from operations per share, as well as free cash flow. And so consistency to us is a measure of company quality, because a management team that's able to grow its business, to grow its sales and earnings and free cash flow over time at a fairly consistent rate means that there's a plan in place, that they have a business plan that they are executing against. They're not opportunistic purely. They're can be taking advantage of any opportunities that come along, but they're not trying to chase fads. They're really trying to build a business over the long term. And to us, consistency of past growth can really give us a sense that the management team is functioning well. So here are a couple of real estate investment trusts. Again, these are the names that you haven't heard of in that smaller, mid-sized to smaller company area. And again, because these are real estate investment trusts, the blue graph here is funds from operations per share. Typically in our analysis, that's adjusted funds from operations per share, but you also see free cash flow as well as revenues. And kind of typical of real estate investment trusts, you'll see the revenues growing at one particular rate and funds from operations growing at a reduced rate. But you can definitely see the consistency here. Phillips Edison is a younger company, so not as much history, but again, the trends are all heading in the right direction, and we like to see that those straight lines moving up and straight, and in many cases parallel when you're looking at operating companies, with REITs being the exception to that. And then our fourth criteria is governance, evaluating the management and the board's alignment with shareholders and their capital allocation practices. Often the proof is in the pudding. If you look at corporate governance, the answer to is the company's management and board doing a good job at being aligned with shareholders comes out in their results. But we can certainly look at their policies about share issuance and repurchasing, the dividend payments, and how they are handling debt. So here we have Nexstar Media on the left, and you can see that distinct downtrend in shares outstanding while dividends are increasing, and debt is being paid down over the last half decade. On the right is Honeywell, so a much larger business there, but also shares declining, dividends increasing. Total debt had been at a manageable level, has increased in the last year due to some discrete acquisition activity that the company undertook. We're not going to ding them based on that increase. We believe management still has a good handle on their cost of capital, their balance sheet, and so we're going to give them the benefit of the doubt that they know what they're doing with the borrowing they've got, that they will take advantage of opportunities to refinance, to reduce the debt load, and manage the interest coverage, so they don't get disqualified for that. But they still remain part of our coverage universe. So hopefully those companies are good examples, a mixture of names with which you're probably familiar, as well as some companies about whom you have not heard before. Our approach, we position it as a strategy for investors who perhaps have been using a growth total return strategy for many years, perhaps many decades, have been satisfied with the results, but as they reach the later stages of their investing life cycle, are ready to ease up on the throttle. It may not be desirable to simply sell your stock portfolio and buy ETFs, or switch into bonds, or modify your approach, but perhaps if you're comfortable holding individual stocks, then you can simply start to replace some of the companies in your portfolio that don't serve that desire for perhaps some lower volatility, and still delivering capital appreciation, but without the objective of perhaps outperforming the entire market. So the trade-off is you give up a little bit of return for an approach that has a little bit lower volatility. The average beta of the companies in our universe is about 1.1. So slightly more than the broader market, but nowhere near the excesses of the Magnificent Seven or the mega cap tech darlings of today's market. And so for us, this is a strategy that many investors should be considering if they're worried about volatility, if they're worried about risk. We think that this is a style that is, kind of falls between the cracks between the pure dividend yield chasing and the pure growth investing, total return growth at a reasonable price style of individual stocks. We recognize this approach may not outperform broad market averages, but if we do deliver lower volatility, then we will have achieved our goals. So a couple of takeaway thoughts. We think that chasing high yields purely for yield's sake is a flawed strategy, that if you want to be successful when investing in dividends, you can focus on total return. So with a hefty portion of that return being driven by dividends, but also be mindful of the ability of the underlying companies to grow their businesses. Those four areas, capital return, growth, stability, and governance, are easily analyzed. You can use our stock selection guide tool. You can use any number of screeners. A simple read through of a company's financial statements can often give you a sense of how well companies are working in those areas. And hopefully at the end of the day, you'll benefit from the reduced volatility.